Today I will talk to you about ratio analysis, another flipped lesson for Business Studies 3 students. This is all about analysing financial statements, namely looking at the income statement in terms of profitability, cash flow statements in terms of their liquidity, and the balance sheet, very important statement. We look at stability, liquidity, gearing and solvency. All these terms will be explained to you as we go along. Why do we have ratio analysis in the first place? Well, we want to examine the profitability, and for that I will look at the net profit ratio, the gross profit ratio and the return on owner's equity. We want to work out how stable the business is. For that we look at the current ratio and debt ratio. Liquidity is the amount of cash being generated through the business and the ability to pay short-term debts, and with that we look at the current ratio. And lastly, solvency. How solvent is a business over a longer period of time, its ability to meet its longer term commitments, and for that we look at the debt equity ratio. Let's start with profitability. Simply, it's the earning performance of a business. It depends on how much a business can maximise its profits by increasing its revenues and minimising expenses. So the gap between revenues and expenses we want to be as big as possible, which represents the profit. Let's look at the income statement. It's also called a profit and loss statement or sometimes a revenue statement, so it all means the same. It's used to measure profitability and or earning capacity, the ability to earn money given the amount of assets or money that we have employed in the business. So as I said to you before, profit is simply by looking at the income, the revenue, and from that take away our expenses, also sometimes called our costs. We use the figures from the income statement to calculate the gross profit ratio and the net profit ratio. Let's look at an income statement in more detail. Up the top we've got the level of sales, and from that we take away a cost of sales, a cost of goods sold. So if I'm operating a clothing store, all the gross sales that I make, the sale price is calculated here, and all the cost of the clothes that I bought in order to put up for sale is represented here. So this is really the engine room of the business, so the gross profit is a very important measure. From that we have three types of expenses. As selling expenses, you can see here advertising and sales salaries form the biggest part, giving a subtotal of $522,000. Admin expenses, office salaries, here you can see again salaries being a bigger proportion. They represent $485,000 as a subtotal, and the financial expenses here. And the big proportion there is interest, so straight away I know that the business has borrowed, and I'll be interested looking at the balance sheet to see the level of borrowings and the level of solvency in the longer term. You can see that if you add these subtotals here together, you'll get the total here of 1.144 million, and that is taken away from that figure there to derive at our bottom line profit of $656,000. Let's look at the gross profit ratio. It's the amount of gross profit generated per dollar of sales. As you saw on the previous statement, on the income statement, it's sales less cost of goods sold, giving us our gross profit. So it's the amount of sales available to meet expenses, resulting in net profit. So that's the profit in the first instance, and then from that we take away the other expenses, then we derive our net profit. Let's have a look at the actual ratio, the formula. It's gross profit divided by sales. Fairly simple. Here's an example which I will work through with you in a moment. So in this instance we've got 1.8 million, that's the gross profit, divide that by the net sales of 5 million, giving us a gross profit ratio of 36%. Those figures I derive from here the gross profit there and the sales there. So I'm going to walk you through how to calculate the actual ratio. So there are those figures I've picked out from the income statement. Here's my ratio formula, gross profit divided by sales. Simply what I do, I take the 1.8 million, divide that by the 500, or the 5 million, I beg your pardon, and you get 0.36. You multiply that by 101 to derive your percentage of 36%. What does the gross profit ratio show? Well, it shows the effectiveness of inventory selection, the valuation, the pricing in terms of the markup, and also discounting. So what that means is that if I have good inventory selected, then people will want to buy it. If it's not so good, also fashionable if you like, then it'll hang around. I will then have to discount my sale price, and therefore that results in a lower markup. So the markup's amount, the percentage amount that I put on top of the cost price of the goods that I put in the store. For example, if I buy an article of clothing for $50 and I have a markup of 100%, so I put another $50 on top of that, so my sales price that I sell to my customers is $100. Obviously, the higher the ratio, the more profitable. If it's low, then we might need to look at cheaper suppliers, and we may be able to get stuff online even. Another way of doing that is to increasing the markup. Now let's look at the net profit ratio, very similar to the gross profit ratio. It's the amount of net profit generated per dollar of sales. Net profit is sales less cost of goods sold less all of your expenses. So it's the amount of sales that results in net profit. Here is the formula, simply net profit divided by sales, and here's a numerical example which I've derived from the income statement that you saw earlier. So net profit was 656,000, divide that by 5 million, which results in 13.12%. So in another way of saying it, if I sell something for $100, then I know straight away that $13.12 is the amount that I'm going to pocket as the owner, or we're going to pocket as owners. So I got the net profit from the bottom line here, down here, 656,000. Divide that by the 5 million. Let's just follow that through. There's my formula. I've plugged the 656 into there, and the 5 million there, giving me 0.1312. Multiply that by 101, and there you have the percentage of my net profit ratio. What does the net profit ratio show? Well, obviously the higher the better, the more profit we've made. We do need to compare this to previous periods, or in some instances we can compare that to industry averages. If it's low, then expenses may need to be reduced, so we need to look at how we can reduce in order to make some savings. And unfortunately the biggest cost factor tends to be wages, so we need to look at how we employ people and for how long, and in the worst case scenario we may need to let somebody go. We can also look at the other side by looking at the sales, okay, and we can do that by increasing advertising or changing the sales price. Now we come to the return on equity. Now this is a very, very important ratio, because if you're going to go in business, you're going to make a certain rate of return, because you need to compare that to other ways of earning a return, or other ways that you can put your money to work. For example, you can put it in the bank or in the share market, for example. So it looks at how effective the funds contributed by the owners have been to generate profit. It's commonly called the return on investment for the owners, and it's something that you try and work out before going into business when you do set up your business plan. So how do we calculate it? Well, you take the net profit and divide that by the total equity, which is the total amount of ownership by the owners in the business. For example, here the profit is 21,500, and divide that by total equity, which gives us a return on equity of 38.1%. Now 38.1% is considered good. Yes, as a general benchmark, anything above 15%, 15 to 20% is okay. Now let's have a look at the balance sheet where these figures came from. Let's just examine it first up. On one side you've got the assets. There are on the left, as you can see. So they're the things that the business own. So they've got cash, accounts receivable, some stock. They've also got land and buildings, fixtures and fittings, and so on. Okay. You can also see that we've divided the assets in terms of the current assets and non-current assets. Current assets simply means the assets that will be turning into cash in the next year, 12 months. That's what these represent. And these assets here we're going to keep for the longer term. On the other side, it looks at how these assets are funded. First of all, by liabilities. In another way of putting it, by debt. You can see here that again our liabilities are separated by current and non-current. Current meaning that these liabilities are going to have to be paid in the next 12 months or even before then in most cases, and non-current liabilities represent debt over a longer term. Mortgage commonly can be 20 years or more. Okay, so the other form of finance that we have to buy the assets is from the owners, obviously, and they've put in the capital, the initial part that they put into the business, plus the profits they've had over a period of time, giving us a total equity. So in relation to what we're trying to calculate, we take the retained profits, which is the profit, and divide that by the total equity that we've got in the business. Now let's do the calculation. So the net profit, as you saw, is 21,500, total equity 56,500. So now let's put that into our ratio formula. Net profit over total equity. There it is, 21,000 over 56,500, giving us 30.3805. Multiply that by 100 on 1, and I've rounded that up a bit. So our return on equity is 38.1%. What does the rate of return on owner's equity show? Well, the higher the better, obviously. It shows a return on investment by owners. I've said that before, and also I've indicated to you before that 15% is a benchmark. Anything better than that, you're starting to do okay. If it's too low, then we obviously need to increase sales, decrease expenses in order to improve our net profit. So there's similar things I said when we looked at our net profit ratio. Now we come to an important part of the business, liquidity. It's the cash a business can access to convert to pay short-term debts. So another way of looking at this is it's the amount of cash flowing through the business to meet our short-term commitments. We look at what we call the current ratio, but in some texts also refer to it as the working capital ratio, but for our purposes I'm going to continue to call it the current ratio. It talks about the extent the business can meet its short-term, and by that I mean 12 months, short-term financial commitments. Is there sufficient cash, receivables and inventories to pay short-term debts, mainly payment to suppliers? Receivables mean an amount of customers that owe us money in the short term, usually on account on 30 days. The current ratio is calculated by looking at the current assets by simply dividing by the current liabilities. And here's a quick example. 26,000 is the current assets, divide that by 8,500, and we have a ratio in this instance of 3.05 to 1. And it's expressed as a ratio to 1. So that means how many times are current assets current liabilities, or how many times is current liabilities covered by current assets, is probably a better way of putting it. And here I've got an important benchmark again. 2 to 1 is acceptable. Anything below that we start to get worried. Anything over that, it's fine. Now let's turn to the balance sheet and see where we got these items from. So current assets, there you are. The total was 26,000. The total current liabilities is 8.5. So we plug those into our formula, 26,000 over 8,500, giving us that ratio which I explained to you before. What does the current ratio show? Well, it shows short-term financial stability. The higher the better. 2 to 1 is acceptable, which means, as I said to you before, double the amount of assets to cover its liability. So 2 to 1 is comfortable. Now let's turn to gearing. It's also called solvency. So solvency is how solvent a business is in the longer term. So can it survive in the longer term? It talks about the ability to meet commitments in the longer term. In particular, it measures the relationship between debt, we call liabilities, and equity, what the owners have put in. In other words, the capital that they put in. The debt to equity ratio is the proportion of debt and the proportion of equity to finance the business. The business employs a whole lot of assets, remember from looking at a balance sheet, and those assets are financed by debt, called liabilities, and we call that external finance because that's come from external from the business. And equity, the amount of capital that comes from the owners, who we call internal finance. So let's look at the debt to equity ratio. It's the total liabilities divided by owner's equity. Here's an example. If our total liabilities are 73,500 and our total owner's equity is 130,000, we have a ratio of 56.53%. Now let's turn to the balance sheet to see where I got those figures from. Total liabilities 73.5, total owner's equity 56.5. Now let's plug that into my ratio. As I've said, total liabilities is that, total owner's equity is 56.5. My formula here, as you can see, is total liabilities over the owner's equity, which means that we have a ratio of 130%. What does it all show? Well, it shows the extent to which the firm is relying on external finance to finance the business's assets. The higher the ratio, the less solvent is the firm. Right, so it means the higher proportion of debt in relation to how much is being put in by the owners in terms of equity. The more the ratio, the higher the risk. A ratio of less than 100% is acceptable. One thing that must be noted, however, is that level of gearing increases profits. So in one sense, having some level of debt is good. If you think about it, if I want to increase my business and borrow the funds to buy a new machine, something that's going to generate income, for example, that's getting income and hopefully profits. So I would have borrowed some money to buy that machine, which increased my level of gearing, but has increased my profits. And that's why we say a ratio of 100% is acceptable. Anything below is okay too, but we don't want a 0% of debt equity ratio, because that means that we can get more out of our business. So that's the conclusion of the ratio analysis. I hope you got something out of it. You'll be getting lots and lots of follow exercises, case studies to do to check your understanding and to apply what you have learnt in this flip lesson. I hope it's been useful. Thanks for listening.